All right, let's jump right into this. Welcome to this explainer where we are going to unpack the really fascinating research and market observations from Jalen Cassidy. Now, Jalen is an associate broker with Silver Creek Realty Group over in north central Idaho, and he runs advanced real estate. Today, we aren't here to predict the future, and we are definitely not here to pressure you into buying or selling. Instead, we're taking a close look at a very specific shift that hit the real estate market in 2026. The goal here? It's simple. We want to help you understand the underlying economic forces at play so you can make wiser, long-term real estate decisions. Because as Jalen's philosophy emphasizes, better decisions absolutely create better futures. So let's start with a first-hand observation from the summer of 2026. Jablin noticed something incredibly curious happening in his day-to-day work. Properties were still getting a massive amount of online views. People were constantly saving homes to their favorites on all the listing platforms. The digital interest was 100% there. But suddenly, that attention just stopped translating into physical showings, phone calls, and actual offers. The big obvious question became, why are buyers still interested enough to look, but suddenly entirely lacking the confidence to act? And this brilliantly illustrates our central mystery. On one side, you have all this high digital engagement, the clicks, the saves, the shares. It's basically digital window shopping. But on the other side, empty open houses and quiet phones. What exactly changed in the market to make buyers freeze up like this, even when their underlying desire for a new home remained so high? Well, to figure this out, we can't just look at real estate in a vacuum. We really have to pull back and look at the broader economy. Section 1. The economic chain reaction. Markets rarely shift because of just one isolated event, right? It's almost always a chain reaction. It's like a giant line of dominoes. First, global instability and geopolitical conflicts disrupt energy supplies, which then impacts oil prices. When oil goes up, inflation expectations rise right along with it. The bond market reacts to this by stepping up treasury yields. And because mortgage rates are tied incredibly closely to those yields, borrowing costs go up. Finally, that higher monthly payment lands squarely on the shoulders of the local buyer, totally squeezing their confidence. It is a literal straight line from global headlines right down to a family deciding whether to put an offer on a 3-bedroom house in Idaho. So the absolutely crucial point here is that affordability isn't just about the mortgage rate you see flashing on the news. It is the heavy, combined weight of everyday reality. We are talking about elevated home prices measured against household income, plus the mortgage payment, plus rising property taxes, climbing insurance premiums, utility bills, and just the overall cost of living, the whole shebang. When buyers are looking at properties online, they're calculating all these factors in their heads, and it's leading to this paralyzing fear of overpaying. Section 2, beyond just mortgage rates, looking at historical context. To really grasp why buyers are hesitating today, we have to look at the environment they just came out of. Following 2020, our economy became heavily dependent on unusually cheap borrowing. We saw an era where tons of households locked into these incredibly low 2 to 3% fixed-rate mortgages. The entire real estate ecosystem, buyers, sellers, investors, we all got accustomed to this incredibly inexpensive money. It fundamentally changed what people thought was normal. But as we know now, that normal was actually a massive historical anomaly. Now, you've probably heard a parent or a grandparent say something like, well, in the 1980s, my mortgage rate was 15%. And yeah, nominal rates absolutely were higher back then. But here is the real kicker. Homes back then were much cheaper relative to household income. The price-to-income ratio was completely different. Today's environment feels so uniquely restrictive because we are getting hit from both sides. We have elevated mortgage rates combined with significantly higher home prices. Section 3. Lessons from past markets. So what happens when an economy that is completely hooked on cheap money suddenly has to adjust? We can actually learn a vital lesson right now by looking outside of residential housing and seeing how the commercial real estate sector is handling this exact shift. Commercial financing often operates quite differently than residential. They frequently use 3, 5, or 10-year loan maturities. Now, the structure isn't inherently bad, but the risk happens when an investment relies entirely on refinancing at highly favorable rates in the future. Today, commercial properties that cash flowed beautifully under cheap financing are facing immense stress. Why? Because these short-term loans are maturing, and it's forcing owners to refinance in a much higher rate environment. And this brings us to one of the most important principles in Jalen Cassidy's framework. The major takeaway for everyday residential buyers is this: you should never, ever purchase a property that is only affordable if you assume rates will decline in the future. A future refinance should be viewed as a wonderful bonus that improves an already solid purchase. It should never be required to rescue a bad one. Section 4. Returning to North Central Idaho. Okay, let's bring all this macroeconomic data back home to communities like Kamia, Kuskia, Stites, and Grangeville. How are these massive global shifts actually showing up in your local neighborhood right now? Well, in the spirit of intellectual honesty, we really have to distinguish between what we know as hard facts and what we interpret. Verified facts from the local MLS data show that inventory has indeed increased, and properties are sitting on the market longer. But Jalen's professional interpretation of this data is that the reduction in buyer urgency is largely a psychological shift. The fear of missing out, that intense FOMO that drove the low inventory years, has essentially been replaced by the fear of overpaying. So while the market has certainly slowed down, a buyer's market doesn't necessarily mean prices are just collapsing across the board. Instead, it means buyers finally have some breathing room. There's more inventory to choose from, far less competition, and significantly more negotiating power. We are actually seeing motivated sellers who are way more willing to consider concessions, rate buy-downs, or even creative owner financing to get a deal done. Section 5. Making wise real estate decisions. So, how do you actually apply all this information to your own life? How do you cut through all the noise and make a decision without reacting to fear-based headlines? Well, this quote perfectly captures the advanced real estate philosophy. The goal of this explainer isn't to push you into a transaction. Whether you decide to buy, sell, or just wait it out, success isn't measured by a closed deal. It's measured by whether you made a wise decision. Understanding the market, your options, and the trade-offs, that always comes first. So, when does buying actually make sense in today's shifting market? Honestly, it makes sense if you can comfortably afford the payment today under current rates. It makes sense if you have sufficient financial reserves, a really clear long-term plan for the property, and if you aren't relying on immediate price appreciation or some desperate need to refinance next year. If you are financially prepared and you meet these criteria, the current market hesitation actually provides a really unique window of opportunity. You can negotiate far better terms with a whole lot less competition. I want to leave you with this final provocative thought. Nobody, and I mean nobody, knows exactly where interest rates or home prices are going to go. But wise decisions don't require perfect predictions. They just require a totally honest evaluation of your financial reality right now. Ask yourself, does this purchase make sense for your future today without having to rely on the hopes of tomorrow's market? If it does, you're on the path to a wise decision. Thanks so much for joining me for this explainer, and remember, better decisions create better futures.